Hello and welcome everyone. Thank you so much for joining us for today's State of Freight webinar. My name is Julia Becker. I'm the Vice President of Media Operations here at FreightWaves. And as always, I am joined in the studio by FreightWaves founder and CEO Craig Fuller and SONAR's Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover the latest insights from SONAR, current market trends, and insights from our experts. Craig and Zach will also be answering your questions live during our discussion today at the end of our conversation. But before we get started, I want to cover just a couple of quick housekeeping items. If you have any issues or questions during our webinar, you can reach out to me via that audience chat function in your webinar console, and I'll be in touch to help you out. If you have questions for Craig and Zach, enter those in that Q&A box in your console as well, and we will answer as many questions as we have time for at the end of our discussion. I'll also be sending you a link to the recording of this webinar in case you want to watch it on demand or share it with your colleagues. And with that, I will turn it over to Zach to kick off today's discussion. What you got for us, Zach?
All right, thank you for that wonderful introduction, and welcome to the new year. And it brings with us the return of Craig Fuller to the State of Freight. We've missed you for the last couple of months, but Craig, I think you and I feel very similar about 2026 for the freight. I think we're both, I would put me in the moderately bullish stance. I think you're a little bit stronger than me, but I think we're still directionally in alignment here with the freight market.
I don't think anyone who's watched the show would be surprised that I have more extreme on anything, whether it's good or bad. I live in, the world of gray, is it my black or white? I definitely am bullish. I think there's a lot of reason to be bullish, and I think it's largely a capacity reduction question. The broader U.S. economy is certainly, I think, in a better position than it's been in some time, or at least some of the excesses that we've had seem to be sort of a function of where we've been versus where we're going, and so I call it more gray on the U.S. economy and how fast we see a recovery in demand. But certainly, I think the current capacity situation is quite constructive.
Yeah, I saw the debate you had with Ken Adamo, DAT, and I think everyone's in agreement that a supply side type market flip, which would be a contraction of capacity, isn't super satisfying. I think that was the takeaway there. And the way that we're seeing capacity reduce, it's not coming from demand side dynamics. It's more of a supply side.
I think it's more satisfying.
Okay.
Because I think ultimately capacity reduction is a more sustainable development than sort of the broader demand side.
Fair.
The reason it's more sustainable is that ultimately it creates a more constructive supply and demand balance element. Like if you get high demand, then certainly that's a short-term pop, but it's
like a sugar high. Yeah.
But what we'll see is that capacity could easily correct. Capacity does come back. I think the fact that we are seeing capacity contract, which we haven't seen really in years, despite some of the volume. If you go back, starting the freight recession started in 22, it was a light volume period in time. There was too much inventory, the bullwhip effect. Yeah. But we saw even the broader economy started to really heal in 23 and 24, and we saw the market the economic demand come back into the economy. That drove some of the freight market, but we saw capacity correct faster. And so I actually think the most rewarding thing from a freight market perspective is to reduce a lot of this excess capacity.
Right. So I want to pull up the tender rejection index, the SONAR truckload rejection index, and talk about that a bit, because this is really where a lot of my bullish sentiment comes from, is the fact that we are sitting in the middle of January without a winter weather event or a strong cold weather plunge to this point. December was actually kind of cold, but January has been fairly mild. And what we've seen over the past few years are these winter weather events that really help support increased or elevated tender rejection rates. Craig, we're still above 10% in the middle of January, and we're not really seeing a huge plunge of the tender rejection rate or the tender rejection index thus far. And I think for me, this This is really, and you see the variation between the yellow and the white line there, and there's a huge gap. Last year at this time we were at about 7.3% tender rejection rates. This year we're at 10.2%. And this just, to me, illustrates the fact that we have lost a lot of capacity, and the market is way more vulnerable.
Yeah, by the way, my mic apparently was not on.
Okay.
Small technical difficulty. I don't know if anyone could hear what you were saying before, but they came and told me that my mic wasn't on. But look, I think the rejections are certainly above 10%. If you look at this is the new SONAR truckload rejection index, which is a richer, deeper set of data. It has a lot more CPG exposure than the traditional OTRI index does. OTRI tends to be a little bit more skewed to manufacturing and some retail. This has a little bit more CPG in it. And so it is to give us a more balanced perspective. Regardless, both indexes are doing well. The SONAR truckload rejection index is above 10%.
Yeah.
I think it's a really positive development for the freight market, especially in light of how soft volumes are.
Yeah, I think, to me, the fact that we're in January. January, I think Kevin Hill said it best one year. He's like, January is the year or the month of the year that you're standing around and sharing cat memes because there's just not a lot of freight volume.
But it's been a really cold winter. And I don't know.
Not in January. It's been pretty mild.
Well, it depends on where you're at. I mean, you had that massive storm that hit in Michigan, in the Midwest.
The Midwest has been cold.
It was really at the end of that last week of December into January. And they're now calling for a big polar vortex to come down.
We got a big dip in the jet coming this weekend.
So look, this will be, I think we do see when winter weather hits that it is disruptive to freight. The winter storm that we got in late December was a non-event simply from a freight standpoint because there was nothing moving. That's the time of year. But look, January is a really hard month to get a read on the market.
Yeah.
I think the fact that rejection levels are still where they're at, above 10%, despite the low volume we've seen in the freight market, tells us that the market is certainly in a much better shape. And I think what's really interesting is looking at the breakout between contract and spot rates, and how much spot rates have been on a real tear lately, while contract rates have only recently moved.
Yeah, and contract rates don't move that quickly. Like if we pull up the chart that I have in front of me here, which is the van contract initial report, versus the NTIL, which is the spot rate removing a certain amount of fuel. You see the green line on this index if we get it pulled up here. But basically the story is that spot rates, very volatile, very reactive, shooting to the closest touch point that we've seen in recent years since the pandemic ended. And contract rates, of course, they get negotiated on longer cycles. By definition, they are mostly 12 months. One of the big questions I get asked, Craig, so far this year, the last couple of months has been, how do I think, one of our, at F3, I believe this even came up several times, what do I need to do as a shipper to kind of get ready, to handle a market that has so much uncertainty in capacity conditions for the next year?
Well, look, I think the risk is on you if you're a shipper.
Yeah.
And I think the reality is that I believe double-digit rate increases are coming to the contract market, which sounds like a huge number. In a normal market, when we had back in 2018, people were talking about 6 to 7% rate increases. That felt like, oh my God, that's a big number. A 10% rate increase right now, while in itself would be a big number, we've seen contract rates drop as much as 30% in the last 2 years. And so in many ways, they're clawing back some of those some of the losses from a motor carrier standpoint. And remember that a lot of the motor carrier costs have significantly increased, unabated.
Yeah.
And so I think what we'll see is a situation where capacity is going to be really tight. It's going to continue to be tight. It could tightening even further. I think a lot of this is immigration related, and it's going to impact the trucking market because of immigration related activities and compliance crackdown. You have to look at the other sectors that trucking competes from a labor pool perspective. Warehousing is one of those sectors. Manufacturing is one of those sectors. Residential construction is one of those sectors. Food delivery, all the sort of Uber, that is a sector that we compete with. And as we see more compliance crackdown happening across the country, that is going to take more and more drivers out of the market. The thing that everybody gets caught up in the truck sell number, and I see this stuff shared on social media about the total number of truck sales. And there is I'll call it a perhaps uninformed view that truck sales are somehow correlated to the total capacity in the market. And it maybe 10 years ago it was that way.
Yeah.
Like I remember this was growing up, I would hear about truck sales as a proxy for capacity. And maybe that was true at one point in time. That doesn't seem to be true anymore. Everything seems to be the driver availability story. And so as we see the compliance crackdown happen in trucking, and we see competing labor forces happen across the trucking labor force and the economy, then I think we're going to be in a situation where capacity is going to be incredibly tight. There's not going to be a relief valve.
Yeah,
And so that is just on the capacity side.
Sure.
And so if I'm a shipper, I am playing defense in every single way. And I'm going to have to take some rate concessions. I'm going to have to give some rate concessions to the providers that I'm doing business with, because if I don't, the risk of not having trucks show up is actually quite high.
Yeah, and of course, we're releasing today on freightwaves.com, and also you can go to the GoSonar blog, the Shipper Preparedness Guide, for those of you that are interested in taking a little quiz to see where you're at in your route guides and your compliance and what to expect moving forward. But one of the big...
Now, where do they find this?
GoSonar.com, the blog, or it's going to be released on freightwaves.com later today.
You can find it.
Yep.
We should put it at the top banner. Tell Julie to put it on the banner bar.
She hears you right now, I bet.
Okay, let's hope she does. And then we get it on the banner bar, that way people can find it.
There you go.
This is something I think is really important if you're a shipper.
Yeah, and also
are you ready? Because it is quite possible that we could see a pretty substantial capacity crunch this year, simply because you have this layup of tight capacity. Tender rejections prove it. Spot rates rallying prove it. In fact, you see in contract rates, we've seen a recent increase.
Yeah.
Contract rates are a substantial lagging indicator.
And they're also prone, the increase you see around the holidays is less about an actual sustained rate increase and more about route guide deterioration as they fall down.
For sure. But I think that the risks are actually quite substantial right now.
I think this run up, Craig, to me, like that big parabolic move in spot rates, once there's a story that just shows you the pent up potential energy for those of you that took physics.
It's spring loaded.
It's so wound tight.
But it's because largely motor carriers have not been making a profit. There's two things happening in the spot market that's really interesting. One is by getting rid of the lower quality operators that were willing to take rates lower than the operating costs, than everyone else's operating costs, because they were hiring labor that was willing to run more hours than they were legally allowed.
Right.
And then taking wages that were far below what competing labor, American labor forces would take. Then what you end up with is naturally the bottom's going to come up. And I think that may explain a lot of the spot market, is that it's the bottom feeders that really didn't operate with under traditional economics that are out of the market, that is allowed for that increase to happen in spot rates. And getting it back, in fact, we have a tracking where we look at the profitability index of carriers, and what we're seeing now is that finally in the last couple of months that they've been making money. They've been making money for much of the cycle.
Yeah, no.
Their operating cost was higher than what they were able to run freight for.
Yeah, I think the interesting thing, we heard from the TCA data that essentially like the best operator, I think I heard this from you, the best operator in there this last year was like a 103, 102 OR. So they were losing 2 to 3 cents on every dollar that they were spending in the operation.
And keep in mind that operating ratio basically does not include the working capital that they need to operate, and the financing that they need to operate. So it only tells you the operating profitability of the business. It doesn't include all the other factors that go into operating a successful trucking company. And so one of the things that people have been talking about is that the truck orders last year declined significantly. They had bounced back in December, but prior to that, they declined. And a lot of that's because carriers can't afford to buy new trucks.
Yeah, and a lot of that, of course, replenishment cycles kind of being askew of the normal process. As somebody who used to calculate
they had this massive hangover from COVID, of this massive back order that the OEMs were living off of, which distorted what you would see in a normal cycle. And now we're in a situation where a lot of trucking company balance sheets have been just absolutely obliterated.
Yeah.
And we're not going to see really, until conditions are ripe enough where motor carriers believe that these conditions are sustainable over the long term. And I don't think, even with the developments that we've had in recent weeks, I think most people are very skeptical because we've had so many false positives.
Yeah.
How many times, Zach, have we talked about we think the market's recovering in the last 4 years? Like, it's happened at least a couple.
Legitimately,
there's been a couple of times we've been looking. Well, okay, I would say there's been a few times throughout the last couple of years where we've gotten some data and it's like, could this be it?
Yeah.
The only time that I was absolutely sure of it, absolutely positively and have absolute conviction was last November, where we certainly saw capacity come in line with the demand at that moment in time. But then what happened is demand collapsed right about the time that the market was improving. And these were tariff related. Government stimulus was being pulled. There was just a lot of factors in the economy that were called freight to slow down.
The economy, again, I've said this numerous times on this show, like, we're not economists. And even the economists have been really confused.
Dude, they've been wrong. They were wrong about the whole tariff causing massive inflation.
Right.
Like, that is clearly... perhaps I got it wrong on tariffs and what it would do from a sort of economic stimulus basis. The guy thought we would see more announcements and domestic consumption or production that we've seen. Like, that has not played out.
No.
But the thing that I think is pretty fair to say is that the forecast or prognosis that tariffs are going to set off some type of hyperinflation, that was largely an accepted view by economists. Is that it was. It may be a one time, but it was going to cause a shock to the system.
Right.
It caused a demand shock.
Right.
I don't believe there's any evidence that outside of very specific products that it's caused any level of real market level inflation. And you see today's CPI number
2.7
was 2.7. That's far below where we were. But even if you break up the components that are driving that, it's stuff that's not tariff related. Food is one of those that is up, but a lot of that's probably labor force related and energy cost related.
Looking at PPI data, and again, there's definitely some inflationary pressure from tariffs, but I think that we were already...
Those costs are not being passed on.
We were already seeing this component of inflated costs from the pandemic era still being absorbed and passed through into the consumer.
It takes 6 to 12 months for the data points to show up.
Yeah.
And what I think is very clear is that we have not seen market level inflation triggered by tariffs. If anything, tariffs have destroyed demand due to uncertainty and noise and just the lack of confidence. It is showing up in some of the wholesale prices, like companies have had to eat it in some of the components. But in terms of consumers eating inflationary outputs due to tariffs, it just isn't in the data that supports that that's been the case.
Well, let's pivot over to that demand component because I want to talk about the SONAR truckload volume index. And it's not coming out super strong. And I think most of the years we talk about demand as kind of the primary indicator of truckload health. We don't have to do that this year, correct?
It's all capacity.
Yeah.
It is, arguably it's been capacity for 3 years.
Yeah.
But certainly it doesn't.
This looks, and you can barely see the white line as we started the new year here, but it's very far left of the screen here, and it's the yellow line is last year, 2024 is in the teal, and then 2023 is in the pink.
It's that shaded red line, that baseline is telling you where we're at right now. We are significantly lower than where we were last year. Looks like about 10% off from what I can tell. So that's a volume
question.
Yeah.
And so volumes are not coming back. I mean, they're not showing any signs of life in the economy. We did have some intermediate increases around Thanksgiving that looks like retail. It was really retail inventory levels.
Yep.
But the reason I think the economy could bounce back, Zach, and I can make a case for that, is that inventory levels, the LMI inventory index, which is a leading indicator, it tracks the broader sort of economy by as much as 3 to 6 months ahead. Like when we think about this freight data, it's tender data, volume data, stuff is sort of real time.
Yeah.
It's like what's happening right now. Now, to many people, it will feel like a leading indicator because it takes a while for that stuff to filter through. But the LMI, what's really nice about the LMI is it actually tells you what's likely to happen over the next couple of months. And inventory levels are at the lowest levels it's ever measured from sentiment in terms of what people's expectations are. There is definitely an inventory drawdown happening in the economy.
Fast,
quick. And I think what happened, we may get a big judgment tomorrow from the Supreme Court about tariffs. We expected it on Friday. We didn't get it. And by the way, I just want to clarify something. I am not a Supreme Court expert by any stretch. I think I got a low grade in my business law class because I hardly ever showed up. So no one should take any type of legal reading from me, nor do I. But anyways, the Supreme Court should come out tomorrow.
Yeah.
What I have been told is expectations are that the Supreme Court will rule that Donald Trump exceeded his constitutional authority and did not have the right to use IEEPA to implement these tariffs. The question will be, what do they do about it? So if that is a near certainty, or at least is a high probability, prediction markets, I think, are at 77% in terms of the Supreme Court pulling it out. People who are sort of analysts who track that stuff and monitor that stuff also believe largely it will be there. Question is what happens.
Right.
And I had somebody who's close to the White House tell me, who's connected to the White House but close to the decision, again, just had believed that what may happen, and there's apparently precedent for this, is that the Supreme Court may rule that Donald Trump has exceeded his authority, but it may also give him a pass of saying, we're going to let it pass this one time, kind of to avoid the chaos and problems that could ensue. In other words, they're gonna going forward, he can't do it, but they're going to give him a pass. Who knows if that's true? But that is a theory running around the White House inner circle and
it's roughly 130 billion-ish of the 250 billion in tariffs that have been issued so far. That's what the IEEPA
is basically an emergency. It says that the president can act basically decisively in an emergency to decide what's in the country's best interest, and ultimately can blockade another country from trading with us. One of the interesting, Matt Leffler and I covered this on, we have a show called Freight Expectations.
Right.
We talked to, he is much more dialed into this, but basically, because it's being used as taxation to collect taxes, is not something that IEEPA has empowered Donald Trump to do. And that's the big question is, can Donald Trump use the Emergency Act essentially to collect revenues? And what's weird is he can cut off trade to a trading partner. He can say, we're no longer doing trading with Canada. He has according to what I understand, he has the right to say that. Like Canada's a threat, and therefore I've decided not to do trade with Canada. But can he tax is the question. Can he use, and so it's weird because it gives him this pretty blunt instrument, as I interpret it, it gives him this blunt instrument of a lot of authority, but then tariffs are not going the whole way. And so that's a question that I think
that goes back to the whole King George levying taxes thing that Americans really have.
Oh, we did a whole Tea Party
an aversion.
We did an entire Tea Party of it.
So I want to look at the IOTI here, the inbound ocean TEU volume index. That it really, and I'm going to ask you a question, Craig, on this one because we had a discussion about this and pending ruling issues. We just saw the inventory level drawdown being the fastest in the history of the LMI, by the way, since 2016. We've never seen a 35 in that reading before. So with shippers and businesses kind of drawing their inventories down.
I want to talk about this because I think this is important because I was going on this before that. is I think what happened with inventory levels, and the reason they draw down so much, is I think everybody's in a wait and see.
That was my question.
And so I think that's exactly right. I think there was two things that people were wait and see. Is one is they were concerned about the state of the consumer and the economy, and pull back aggressively. We see it in our media business, is that advertising campaigns are it's always the first thing to cut. And so in some of our non-freight media aspects, we've seen companies put they can't get budgets.
Right.
And a lot of it's because they don't know. And this uncertainty has caused a level of conservatism. And I think what is happening with inventory levels is that companies were concerned about consumers. We're concerned about hyperinflation. We're concerned about policy, concerned about whether tariffs are going to exist or not. And even if the Supreme Court does not rule against the administration or says we're not going to do anything with these tariffs, and they leave them be, then I think there'll be some relief there. And I think companies will say, hey, we need to get on. And so I think what will happen is this IOTI index, if we can pull it back up, it is showing we're back down to 2023 levels.
It's doing what we would expect.
We're far off of where we were. We could see things rebound after the ruling, regardless of what happens. Now, if the Supreme Court rules the way people expect them to, which is they rule that Donald Trump exceeded his authority and that he doesn't have the constitutional right to levy these tariffs under IEEPA, then I think we will see a surge of container volume because companies, they know he has a couple of other sections of the law where he can implement tariffs. Right. And there's rules and limitations on what could be done, how long it takes, all this stuff. But there's going to be a window potentially of time before those new tariffs come into effect, where companies are going to try to surge as much product as possible to avoid tariffs. And we've seen there's a precedent for this. We saw this back in 2017 and 18 when Donald Trump first threatened tariffs. We saw it even in 23 and 24 where there was the threat of new tariffs coming in, and companies do go ahead and front load product movements ahead of the tariff impact.
And you can see that in the IOTI over the last few years. This has been a very, I don't know, non-seasonal index for the most part, outside of Lunar New Year, which is that dip that you're looking at in the front end, the little draw up right in front of the Lunar New Year holiday that occurs in the Asian countries. That's why that drops down in February every year. If we get a ruling in front of Lunar New Year, like that to me makes this index go parabolic fairly quickly because they've only got a few weeks, right?
The thing that I understand from what's happened in China is there's a lot of inventory. There's a lot of production stuff that's been produced that isn't being consumed. Right. You see this in some of the European economic
countries,
data where they're effectively dumping products on Europeans.
Yeah, Leland Miller was talking about this for the China Beige Book.
And so it's a problem for Europeans. They haven't, it's interesting because they have no problem doing like tech regulation and putting all these rules in place, but haven't figured out how to fend off the China dumping of products on their economy. But I think what will happen, to your point, is there is a lot of pent up supply of product that will likely come across the ocean the moment that there is that reprieve.
Yeah.
But I gotta believe that the administration has probably written the laws because even people that are close to the administration that I've talked to have said that there is an internal expectation. They believe that the Supreme Court's going to rule against them. Yeah. They won't say that publicly, but people that are actually in the policy making decisions that are close to it that is a belief. Yeah. And they believe that the Supreme Court will rule against them. And so there is definitely preparation to plan for that. So I think if the Supreme Court rules, we'll get some really angry tweets or angry Truth Social posts. But I think within days, if not sooner, we will start seeing a lot of new tariff noise out there.
So wouldn't that kind of put a blockade on all this new ordering?
It depends on how long because some of these tariffs, like Section 232, requires an investigation. Like you have to go and order an investigation. And you saw this with the heavy duty truck tariff that came out. That's Section 232. Kitchen sinks.
Yeah.
These are like, hey, there's been this illegal dumping of products on our economy. They're required to do a Section 232 investigation. It has to go in front of Congress to basically show their findings. That's a 6-month process because the ones we got with heavy duty trucks and kitchen sinks is my favorite because of national security, right? But what we saw was that those were actually ordered under the Biden administration last May. And I think it was October, November, when we got those released by the Trump administration. That's 18 months.
Right.
This administration will want to move as fast as possible. The other thing is we're in an election season.
Next year's midterms.
I think the tariffs have been largely unpopular. Of all the policies Donald Trump's had, it is one of the least popular.
I know it is amongst our constituency.
But it's very unpopular. Even people that are in trucking who are diehard MAGA flag wavers will tell you that they think that the administration got it wrong on tariffs because they've seen the impact of it. But tariffs have the lowest bipartisan approval rating of all of Donald Trump's policies.
Right.
Because they kind of messed it up when they rolled them out. I think if he had rolled out tariffs on China and had focused all the attention on China, I think people would have sort of given them a pass. I think it was the way they were rolled out, the way they were communicated, and the impact it had, which is quite different. But anyways, I think we're into an election season. The last thing that the administration wants is to have 2 years of a contested Congress, where that means Senate all these investigations, impeachment trials, because it's coming. And that means their entire plans for 2 years are gone. And so I think what we'll see is a lot of focus on driving stimulus through the economy this year.
So I want to...
And try to accelerate a lot of their policies that they want, because they don't want to end up basically having these things happen after the turn.
I think you're hitting on a valid point in terms of like how all these tariff implementations, some of this erratic trade policy has created this fog of war, really. And lost in some of this, I think the first tariffs that they rolled out were on Mexico and Canada. How do you think Mexico fits into this equation in the coming year? Because we do have the review period now due for USMCA. And I know a lot of people are concerned about what's going to happen with this. How do you think this fits?
Look, I think a lot of this is going to be, it is interesting because you had the fentanyl tariffs, which were the Canada and Mexico ones.
Yeah.
And I think it's going to be interesting to watch what happens with the cartel question with Mexico. Because there is a perspective in the White House that the Mexican government is being held hostage essentially by the cartels.
Yeah.
There's a perspective that Venezuela is a different situation than Mexico, but there's still a perspective that effectively it's fueling this. And so I think a lot of what we see with Mexico, I think what will happen is we'll see a lot of pressure points using USMCA trade policy to change other types of security policies, perhaps cracking down on the cartels, that will be perhaps more important to the administration than causing a lot of short-term economic damage.
So how do you think that manifests in the way that, you had these businesses that were, after the pandemic, a lot of these companies were thinking China plus one strategies in terms of procurement and manufacturing?
I don't think it changes that.
Okay.
I think largely we can't cut off trade with Mexico, and I don't think it's going to. I think there's a lot of business interest around.
Yeah.
And I don't think we'll see it. In fact, we've seen the administration has come back in recent months and has softened some of their more aggressive tariffs on particular products.
Pasta. Thank you.
Even some of the auto-related tariffs have gotten muted or watered down, if you will, by the time that they were issued. I think the last thing this administration wants in 26 is having a pretty significant economic slump, because they need the 5.1% GDP growth that they're telling to going into the election. They need the average American, his core constituents, and just the average American to feel like this is the direct, the economy's back on solid footing, things are getting better, the quality of life is getting better. And I think that's what they want, because the last thing they want is to lose the midterms.
Yeah. So
But what happens to USMCA? I think we'll see Mexico give some pretty good concessions. I think we'll see Canada give some pretty good concessions. It's interesting because I think Mexico.
But they're still going to remain.
Mexico may be more important in the USMCA equation than Canada is.
Do you see anything overly restrictive on Mexico, though, that's going to change the flow of freight across the border?
In terms of what they can and cannot bring in? No, not necessarily. I think there'll be more pressure to put. What the administration wants, if you look at their policies, is they want some victories with some manufacturing production put in the United States. And I think what they'll do is they'll try to front load a lot of those announcements. And so we could see some expansion happen in investments. Saw this with Taiwan, I think yesterday. Taiwan has announced that they're building 5 semiconductor plants in Arizona.
Right.
And then out of that, they got some concessions on tariffs. And so I think that's, even though what's interesting about that is that the tariffs that Taiwan is under doesn't actually impact semiconductors, but they used the semiconductor investment of TSMC in Arizona as a way to get other tariffs that impact other products muted. And so I think that's how the administration likes it. They want victories. They want to be able to tell the core American public that they have won something.
Yeah.
And I think that is the way you win. I think countries that have Europe has done a poor job of managing it in times. Canada did a really poor job of it early on. It cost Justin Trudeau his job.
Yeah.
And so I think,
and Japan maybe too, like
in terms of
like the politics of that, because they turned over their leadership as well.
Yeah, I think Japan's got its own set of issues.
Yeah,
Korea had a government was affected by that. But I think again, it comes back to the administration's going to want some wins.
Yeah.
If I am advising the Mexican government or the Canadian government, I would front load those wins where you get. This is what we're giving you.
Yeah.
And I don't know that the trade number percentages is as important as the optics of getting investment. And Japan figured it out. They put, $700 billion on the table so that they will invest. And who knows whether we see any of that money.
Right. A lot of.
It's a soft concession.
Little geopolitical gaming there, and this is not the show for that. But I want to land the plane on the capacity issue because this is going to be an ongoing thing this year. And my question to you, as I pull up the Carrier Details Net Changes in Trucking Authority's chart, we're seeing a downturn. This is seasonal. We expect this to happen.
It always happens, by the way. I looked at it.
Every year.
You go back every single year from Thanksgiving Day to Valentine's Day, there was a reduction in capacity. This year might be more. Simply because I think a lot of immigrants, foreign drivers, have left the industry due to the potential for harassment or concerns about being deported or detained. And some of them have left the country not to return.
You can actually see that the downturn started earlier this year than in most every other year.
And that is an immigration story.
And my question to you is, how long does this persist? We just talked about how this December holiday shipping season was fairly good. We saw rates really shoot up. That should support some revenue growth there. For how long it lasts is a big question. But do you think, how long before capacity starts to come back into the market, or if all?
I don't think we have a relief valve.
Okay.
I think there is a case if we get a broader, and I want to say if, we get a broader economic goods, and there are signs. There are signs that the transports have bottomed. We're seeing those rally in the stock market. Paper and packaging some green shoots there. Chemicals. The sort of 3 horsemen of the economy is the transports, chemicals, and paper and packaging. All 3 of those are showing early signs of a turnaround. And so if those 3 things surge, and we get some movement on housing,
right,
and we get some improvements in the auto market due to people buying internal combustion engines and no longer funding EVs but ICE, I think we should see significantly improving conditions for motor carriers. But the relief valve of capacity is not going to come quickly. Carriers don't have the money to do significant driver pay increases,
right,
or expand their fleets.
Right.
And I think because they're not going to expand their fleets without drivers, and they're not going to expand their fleets because they don't have the money to expand their fleets. And the barriers to entry are increasing significantly. Sure. One of the recent announcements, I think came out last week, was that the administration said that if you are on public assistance of any sort, you're not allowed to do remittances. You were denied remittances. It's something like, I think the number is around 60% of immigrants are in some kind of public assistance. And so that will de-incentivize immigrants who come over here to work and send money home. It just makes it less lucrative for them to do so. And so that I think, I think the relief valve over the last 3 years, as it relates to capacity, the increase has been immigrant labor. And I don't think it was obvious to everybody that was as significant of a number as it is.
And do you think that the CDL situation and along with the ELD enforcement of some of these
ELDs, the entry-level driver training program, the CDL mills, even the ATA has come out this past week and talked about CDL mills need to be shut down. We are seeing the narrative shift in the last 6 months from this sort of contested field of differing entrants, where the ATA had one position and the OIDA had a different position, and we're starting to see the industry really rally around getting rid of excess capacity.
Yeah.
And a lot of them, sort of immigration's ground zero for that. And I don't think it should be beyond us that I think the Trump administration has won some credibility with some of their use of the Department of Defense and some of the missions that they've won. American troops have not been harmed, yet we've done some pretty bold, some would say audacious military exercises or missions. One was in Iran, one was in Venezuela. I mean, the stuff it's like a Hollywood movie. Like Iran was the first one, and then the sequel was Venezuela. Yeah. And it just feels like those wins mean that the administration is going to continue to think about very targeted, because they get some huge political credibility for those types of things, much more so than some of the other things that they've been involved in.
And that's a whole nother show.
But I think that's positive for the economy, because I think it what it does is it creates a level of confidence in the American consumer. We have been told for years that America was going off the rails and that our military couldn't. Look at what happened, in Afghanistan, where it was a disaster. We saw in Iraq how bad that was. I think the reality is that we can have a much more precise level of action without getting enthralled in these geopolitical rebuilding exercises, which don't work. And I think that creates some level of confidence among American consumers.
Totally different show. And I certainly am not going to get into the military aspect. And I want to leave time. We got 15 minutes left for Q&A, so I certainly want to get to that. Julia, what we got?
Yeah, we've got a ton of great questions. For anyone who's still entering those, I will try to get through as many as I can. First question here is from Langston, who asks, how should we be thinking about trends between domestic versus international intermodal?
Ooh, domestic versus international intermodal. I mean, it's a good question. I mean, ultimately, international is totally dependent upon the container trade. Right. And so I think as we see an improvement in containers, and I think it all is up to the Supreme Court at this point. And it's not even a matter of how they rule, although that does have an impact on it. It's whether they rule, how soon they rule. I mean, it's not whether they're going to rule. It's how soon they rule. And therefore, the sooner we can get a decision out of them, hopefully as early as tomorrow, then the more, I think the more effective that will be.
Yeah, so obviously the global trade stuff definitely impacts the international container shipping on the intermodal side. Domestic intermodal, however, is going to be completely dependent on whether or not shippers continue to pull forward or have some time or leeway in shipping their transcontinental freight. And if you look at this chart that I have pulled up here, this is all intermodal. It's including international and domestic in it, but it's still in a fairly decent growth phase, even though I just showed you a chart about how imports have kind of come down. This is almost entirely domestic intermodal based growth. in this, the chart you're looking at, and the white line that you're looking at here. And I think this has been one of those trends that's really pulled demand out of the truckload market over the last bit. If we get the ruling on the tariffs and things like that, I think domestic intermodal actually, along with international, continues to benefit.
Well, I think domestic intermodal is going to benefit as long as that there are these long haul trade corridors. And I suspect that it will increase, not decrease, particularly as we see the railroads, not just the UP-NS
merger,
but I think the other railroads have got to respond to that. Like they have, and we've seen this where the non-participating railroads have started to improve their schedules, their route, the way that they are routing volumes, to realize that they have to respond to that. And so I think the intermodal business is going to continue to improve conditions and become a much more attractive product in the future. And we've seen this, like the big IMCs, companies like Hunt, Hub Group, others have also made some announcements where they are investing in intermodal product offerings. And so I think we will see intermodal continue to play an important role. And intermodal has taken a lot of capacity out of has taken a lot of freight demand out of the trucking market.
It was the one calculus that not a lot of people said when they were talking about capacity, transportation capacity in the market a few years back.
No, but it is shown after COVID. I think after the labor contract as well. I think the labor contract created a level of incentives for labor to I wouldn't say get their act together, but perhaps that is the right term, to really help improve the service quality of the railroads. And now we're in a situation where it's benefiting from that.
Yeah, the one caveat to that, of course, is going to be on the sense of urgency. I want to pull up this last chart on intermodal spot rates versus truckload spot rates over the holidays. And it's an inverse relationship. And it's because the sense of urgency around the holidays drove up truckload pricing. Intermodal, because the sense of urgency was there, actually had to lower their rates. And this is not a huge market.
Well, it's also not had to lower rates, but what happens is some of the higher quality freight, higher paying freight gets pulled out of the railroad mix and gets put into truckload.
Right.
And so I think some of that is happening. Mix becomes pretty important. Yeah. If we do see a surge in the economy from a volume standpoint, then that will show up in the trucking data first.
Right.
What we will see is the railroads will continue to increase their rates, but it will be a slower increase. But we're going to need all modes of traffic performing to really to
see a market turn.
Well, when we do see the market turn.
Awesome. My next question is from James, kind of along the same lines. What demand indicators do we need to see to sustain this rally in rates? And can we enter a true upcycle without manufacturing and housing significantly improving?
Yes. I think you could say, and I think we'll look back in 6 months and say this upcycle has already started. I mean, look, the thing that could kill it is some weird geopolitical, maybe the Fed investigation of Powell is a distraction. It causes the bond market to lose its nerve. It doesn't seem like that's happening. That's all there's all these weird geopolitical things that we could get that could do it. A broader economic downturn, a terrorist attack, something catastrophic could happen to kill the recovery. But short of that, I don't see anything really impacting it negatively because this is a capacity question. Going back to where we started this conversation, Zach, this is not a demand question right now. Demand's anemic. Demand sucks. We are not having manufacturing participate in the recovery. We're not having housing participate in the recovery. But there are reasons to believe that could happen this year, that we could see housing come back, albeit slowly. We could see manufacturing come back, albeit slowly. And if those things happen, then that's just going to create additional demand. But capacity's already been being removed out of the market to a level that is currently supporting market conditions.
I agree entirely on that one. The manufacturing component, I feel like, is the big wild card. Housing's already kind of slowly grinding back, albeit very slowly. Manufacturing, to me, has the biggest potential upside this year. It's got a high ceiling because if they get any certainty whatsoever, and obviously a lot of this manufacturing sentiment is going to be driven by a lot of these trade policy negotiations that are due this year. And if we get some of that certainty and get some commitment, we'll start to see that also kind of pick up as well.
There's also like the tax bill that we didn't get to see much of from a benefit last year is going to start playing out this year. You have the highest level of tax refunds in history are coming out this year. You have no tax on Social Security, no tax on tips. Those things at the margin matter. You also have some really beneficial CapEx and manufacturing investment taxes. In itself does not necessarily help. Like if you look at the big CapEx benefits, they don't drive demand.
No.
But they certainly encourage companies to think about how they invest that money.
Right.
And so I think we could get some benefit of that if we see more certainty in the economy.
Mm-hmm.
All right, my next question here is from Tracy, who asks, do you expect refrigerated carrier rates to see double-digit percentage increases as demand builds towards summer?
God, the last place I would want to be is a refrigerated broker. R&R is learning this lesson or is feeling the pain. But if you're a refrigerated freight broker right now, you are hosed. You're absolutely in a world of hurt.
I mean, the refrigerated space in general is the definition of chaos. We've had a couple of years of head faking around the winter months. Protect from freeze, of course, is in play, even though it's warm right now. And refrigerated rates, the RTI is, and the tender rejection rates for refrigerated are still extremely elevated.
But it's because of the tightness.
This market, because it's 20% of the overall capacity, and so it does not take as much.
No, and it's because
reduction.
Also, if you're a guy buying trucks,
yeah,
the trailer is far more expensive.
Yeah,
higher operating costs. You don't see the boom as much as you see.
It's seasonal freight. You've got networks that are like out of balance all the time. It's
a much more brutal market. That's why it keeps it tighter, and it's much more favorable right now. And so I think refrigerated is the right market to be in.
Look at the gap between the tender rejection rates on this chart in the fall. Van was kind of just slowly grinding up towards the holiday. Refrigerated was like, see ya. And then it took an even bigger leap around the holidays. I mean, this is just a market that is so primed. And again, we've seen this this softening every spring. And I don't, this is kind of like an inverse seasonality that we've seen after the pandemic, because produce and all that kind of stuff has kind of been the thing that I think everybody's been focused on. So they're ready for it when the spring runs come. But this just feels like a much more fragile refrigerated market this year.
But you can shake it as a sign when we see tightness. This is what could happen to the broader market.
Absolutely. You need Van too.
Awesome. My next question here is from Scott. He asks, what is your view on independent contractor capacity? Because historically that was a mechanism for carriers to expand their capacity.
Well, I think it's going to be harder and harder for certain carriers to add capacity, and I think they're going to definitely look at some of the interoperators as more attractive resources. I also think the asset carriers have a lot of advantages right now. Mm-hmm. Shippers are starting to think about who is hauling their freight. Yeah. And they're much more likely to trust a Werner, even a Landstar perhaps, and a Swift or a J.B. Hunt, much more so than some carrier that they don't know. And whether or not, Landstar has a lot of independent operators. They are obviously the largest out there, but they have a level of screening they do much tighter than what you see with some of the smaller operators. I think that gives shippers more confidence, particularly with some of the compliance stuff that's happening, some of the liability questions that are out there. I think definitely we could see some expansion of fleets starting to attract some of the independents into their networks.
Yeah, the brokers have their work cut out for them this year.
Well, we're going to see some broker bankruptcy.
Yeah.
I mean, R&R has been rumored. I've had 3 other, and I have to be careful. I've learned the hard way of not getting ahead of myself, either talking about the company specifically or accelerating their demise, if you will. But there's at least 3, call it very large, but $500 million and up, brokers that are on sort of a watch list of insolvency, may technically be insolvent, but haven't put the candle on them yet. That are certainly there, and I think this is going to be a difficult market for brokers.
Yeah, because they're losing a lot of their carrier population that they lean on, and you're going to be increasingly pressed by the shipper community to have reliable.
So it's going to be a lot of M&A.
Yeah.
I mean, I know at least 6 companies that are in some kind of M&A process in freight and brokerage, and these are big ones that are in some type of M&A. The principals have told me that there's stuff going on. I think there's gonna be a lot of M&A. And I also like broker liability question on the 16th.
Man.
It's not going to impact the big guys, it's going to impact the small guys. And so we could see a lot of small brokers, people that operate in their mom's pajamas or mom's basement, or just are sole proprietor brokers on that long tail, might end up becoming agents for other companies or go out of business. So I think we could see a washout of a lot of. I had an executive at another company across the space. I won't bother, but it's a company that sells a lot of technology into the brokerage space. It told me they think the long tail is going to get completely creamed because of new brokerage liability. Do you know about it, right?
Yeah, of course.
Goes into effect on the 16th.
Yeah.
Is the whole question about their bonds.
Right.
And so that is a big deal for the long tail.
Okay. Wow. So just like
So freight could be displaced. If you're a guy with $1 million brokerage, but you're the only proprietor and you don't want to put the bond.
Yeah, that makes sense.
And you can't afford the bond, you may end up having to exit the market entirely. That freight could get displaced into the market.
We haven't even talked about the brokerage capacity.
I mean, brokerage capacity isn't an important factor.
Yeah.
It is the source of a lot of capacity for small operators.
Sure.
I think this is a game where bigger companies are in a much better position to withstand a lot of the things that are happening.
That's kind of been the story of.
It's always the story. I think what's happened over the last couple of years is that the smallest players, the ones that aren't compliant, have actually won. It seems to be those days are over with.
Great. It looks like that is about all of the time that we have for today. Thank you all in the audience for asking such great questions and having great participation today. Craig and Zach, as always, thank you guys for being here, sharing your fabulous insights with us. Be sure to mark your calendars for next month's State of Freight. We will see you again on Thursday, February 19th at 2 p.m. Eastern. Thanks again, everyone.